way that you're going to raise capital and how you as a founder or current investor ultimately going to extract capital from that in an exit scenario. The ultimate outcome that you had, 1.6 billion in the no discount scenario versus 450 million in the fully discounted scenario, actually should raise your alarm. Hey guys, what's up? Today I want to talk to you about a case that I currently have with a client that I can't name, but I'm going to run some example numbers by you to sort of illustrate the point. And the point is one that is going to have a tremendous long-term impact on this B2B SaaS Series A, late-stage Series A company that I'm working with, but they just don't realize it yet. And it is one around discounts. So I work with pricing, obviously, but hence I also work with margins and with profits and revenues a lot. And I think that people are just missing how important margins are for both the long-term health of the business that you're trying to build, but also on the way that you're going to raise capital and how you as a founder or current investor ultimately going to extract capital from that in an exit scenario or as an owner. So I want to walk you through this case to show you the levels of implications that discounting has and how to think about it, or how I usually think about this when helping out my clients, and the step-by-step framework that I suggest you use in order to take control of discounts and use them in a positive way in your sales. So that's it. So I hope that makes sense to you and that it brings value to you. Overall, it's not something that I work with every company, but let's say around a good third, especially the larger enterprise accounts and especially SaaS businesses that have large cloud components like large Asia costs or large third-party license costs. This becomes a real issue. The client I'm working with is serving medium-sized businesses, so a couple of hundred employees up to several thousand, but never the very super large global accounts. They have around $17 million ARR currently, but that is on an on-prem solution. So they're charging a license fee on that, which is a recurring fee, but on an on-prem solution. Now they want to lift that into the cloud to be able to, say, better run product updates and better service the clients and so forth. And also they're seeing that a lot of the clients have a hard time managing the physical infrastructure of server parks in their businesses, often across multiple locations, and really want a SaaS vendor to take the cloud costs away from them as well. So this has been sort of the design part on the pricing model part of the project, and we've run through all that. And we've created a pricing model that essentially says that if they're currently 500 clients they have that pays this total of 17 million ARR, were to all migrate to the new cloud offering that we're pushing into the market, the total ARR would rise up to 150 million, and 9x or so. So not very close to a 10x. So this is, of course, a huge price increase. And I think to some degree that came as a shock to my client, right? So they had thought that, okay, maybe we're going to increase prices by 3 or 5-fold. But when the numbers turn out to say, no, you are going to raise them 9-fold, they got a little squeamish, especially in their sales department, because it's sales that are going to carry this new price to the customers, right? So we ran some math and looked at some competitors and sort of did all the blocking and tackling that you do in pricing to really sort of settle in on that this price is probably close to being right. One of the reasons being that we have around 17 million of costs going into this. So if we before had 17 million in ARR in the new cloud solution servicing our clients, same clients with essentially the same solution, but in another infrastructure framework, we would now have 17 million of costs. So even if we quadrupled our prices, we would barely make any money. So we need to go way higher, hence the 9x. Now, because the sales department feels that this is a hard ask for clients and they are afraid that a lot of them are going to say no and maybe look for other vendors and so forth, they want to be able to offer a discount. So the discount level that has been proposed has been around 30%. So I'm just going to use rough math in this example. So the 150 million are going to be potentially discounted all the way down to 100. right? So my client sort of on the face of it thinks that this seems to be a fair solution, right? So they're saying, okay, so 100 million is still, way more ARR than we currently have. So that should be positive for the enterprise value of the company. And it's, comfortably above cost. So we're still going to make money. And so everything sort of maps out. So the cost, of course, is going to stay the same. So in the, let's say, max scenario where you don't discount and you just charge 150 million list price with 70 million cost, you're going to have 80 million bottom line. Great business. If you discount maximally, only charge 100 top line revenue, you have the 70 million cost, you have $30 million bottom line. Also a great business, right? So really the margin in the first scenario is a bit above 50%, like 53% or something. And the margin in the fully discounted scenario is 30%. So you have 100 million top line revenue, ARR, you make 30 million bottom line after cost. Okay. So not horrible margins on sort of in the landscape of businesses overall. Like a 30% margin is fine. And of course, this is the gross margin. So we still have some overhead and development and so forth to take into account. But let's just run this in gross margins. The example makes sense anyways. So now what happens is that, well, if I'm going to take this scenario and then move forward with it as a business. So my client is a Series A startup. They raised a relatively large Series A. So, but they, in order to hit this new cloud goal that they want to hit with 150 million top line ARR and so forth, they are going to need to raise new capital. And probably they want to raise a Series B and a Series C. And in combination across those two rounds, it's probably going to be something like 150 million US dollars in new capital. So let's say that's 30 million in a Series B and 120 million in a Series C. After which they might raise again, or they will exit either to a private equity fund or a trade buyer or an IPO. That's the plan. Now, here comes the math. If you are, let's say, able to execute the max no discount scenario and run for a 53% gross margin, 80 million bottom line, 150 million top line, your unit economics and the revenue base or profit base that you are going to be evaluated on in those capital rounds are going to be much better than if you have the fully discounted scenarios. So if you have a 20x ARR multiple on a SaaS company, you'd rather want that multiple on 150 million than on 100, right? Just how it works. But the multiple 20x is going to be different because the $150 million company has a much better profit margin than the $100 million company has, right? So maybe the multiple on the $100 million company is going to be 15x, and the multiple on the 150 million company is going to be 20x. So 150 million is 3 billion, where on a 20x and 100 million on a 50x multiple is going to be 1.5 billion. So even though the multiple only drops 25% from 20 to 15, the two scenarios are suddenly 100% apart, from 1.5 billion to 3 billion. But one other thing to reinforce this actually is that if you have a meaningful size as a company, so if you go in and start to make sort of hundreds of millions of dollars in top line revenue, you're probably starting to look at yourself in terms of market share. So how much of the market do we have? How much could we capture with the given price points and the given products and the given competitors? And one of the things that most executives of fast-growing, relatively large, successful SaaS companies don't realize is that their top-line pricing and their ACV, their annual contract value, or the average contract value on a customer, actually determines their TAM, their total addressable market. So if you are able to charge on the same 500 clients or 100 million or 150 million, the latter scenario is going to extrapolate up to an overall larger market potential, right? So let's say that the 500 clients represent 10% of the market, right? If you charge them 100 million, then that market is worth $1 billion. If you charge them 150, then that market is worth 1.5 billion. That's just how it works. So if you do a land and expand strategy where you try to move into the market at a low price, essentially what you're telling all your investors is this market isn't worth all that much. That matters zero when you're small, when you're angel or seed stage or Series A and so forth, because you don't have any meaningful share of the market. Like, it doesn't matter. They know you're figuring it out. But once you're actually gearing up for, let's say, becoming a real business with real bottom line and real sort of muscle in the marketplace, it starts to matter. And because now you say, well, this is likely the long-term level at which you're going to price the clients, more or less. You're not going to 3x your prices suddenly if you have 20% of the market and meaningful competition. So your pricing and the discount levels associated with it really affects your top line, your bottom line, hence your unit economics, but also your total addressable market. So all of the, let's say, major hard numbers that a venture capitalist will look at when they're trying to evaluate whether to invest and if, at what multiple. So let's just assume that we're going to sort of project into the future what happens for this client of mine if they discount maximally or not at all. So we have this range then from no discounts with a perfect execution of this price to executing with the maximal discount mandate that we've given the sales. So, and let's say that the venture capital multiple on the no discount scenario is going to be 20, and let's say that the venture capital multiple on the full discount scenario is going to be 15. So let's say that they raise their Series B when they hit something like an ARR of 25 million. So relatively soon. Now, on a 20 multiple, it's going to be 500 million. On a 15 multiple, it's going to be 400 million. Like rough math, it's going to be a little less than that. So, and then in the Series D, let's say that they're now at 50 million ARR, and the same multiples hold true, 20 and 15. So that's going to be 20 times 50 is a billion. So they reached unicorn status at their Series C. And then in the fully discounted scenario, it's going to be 15 on a basis. That's going to be 750 million, right? Let's round it up to 800. So what that means is that the capital, the 150 million that the founders have to raise in the market, 30 in their B, 120 in their C, is going to be more expensive if you discount fully, because your pre-money valuation is going to be lower, right? So lower base, lower multiple, is just going to be a lower pre-money valuation. So that means in order to get the money, so the growth capital requirement of the business is fixed. It's not that if you grow with less top line, less bottom line, that you need less money to grow. You need the same money to grow. So you're just going to have to give up more of your own equity in the fully discounted scenario to get those capital rounds and be able to grow the company. So let's say that the current founders have 40% equity currently. So in one scenario, maybe they would, if they're raising 30 and 120 million on 500 and a billion pre-money valuations, they're going to be diluted something like 20%. So their 40% is going to go down to 32. Now, in the other scenario, the fully discounted scenario, where they are valued at only, 400 and 800 million, the dilution is not going to be 20%, it's going to be more like 30%. So their 40% is going to be diluted down to 28, something like that. So you have suddenly you end up at the end as a founder with something like 5% less net equity. So 32, 33 versus 28, something like that. So you can say, well, does that really matter? You still have meaningful equity in a business and so forth. Yeah, well, every little thing matters, because of course, what you also have is now you need to actually sell the business. And let's just assume that the multiples stay the same, 15 and 20. But likely when you're selling the business, either to a private equity buyer or a trade buyer or an IPO, so essentially you sell it to pension funds through an investment bank, they're going to shift their perspective from top line growth to something like your to a PE ratio, to your price earnings ratio. So now they're actually looking at bottom line. Unless you have monumental fast growth in an incredibly large market and it's more a play on your technology overall, because in those cases your ARR actually doesn't matter. But if you're selling yourself as a business, as a product that can make money in the market, then they're going to look at the actual economics of those business. So now you're sitting at a point where, okay, we have 100 million top line with 30 million bottom line, or with no discounts, we have 150 million top line with 80 million bottom line. And now we multiply that with good unit economics with 20, or with poor unit economics with 15. So that means that the 20x of 80 million becomes 1.6 billion in an exit for the no discount scenario, whereas the 30 million multiplied by a 15x PE multiple in the full discount scenario becomes 450 million, right? So you have two stages in the calculation. One is good business, high multiple, more founder equity, versus less good business, lower multiple, lower founder equity. So in the good scenario, the no discount scenario, you would end up with 33% of 1.6 billion. So that is a little over 500 million, right? 510, 20 million. Whereas in the, I only have less than 30% of 450 million, I'm going to end up with something like 120, 25 million, right? So you're going to have 4 times as much money as a founder. And this actually applies to your Series A investor and your seed investor and all the business angels and so forth that sort of went along with the ride up until this point, right? If you run the fully discounted scenario, you're going to end up with 4 times less money compared to the no discount, list price executed scenario. If you're a founder and you get $100 million plus payday, maybe you're happy regardless. But if you're a venture fund and you're actually trying to, get your fund back to your limited partners, then this kind of math starts to matter a lot. So you can see that in this range from no discounts to full discounts, there is sort of, and even it's just a 30% discount. You can say, well, we're growing ARR either 100 million or 150 million at the top line. So you can say, well, it's just a 30% difference. But really, it's, if you multiply it out over time with the different funding scenarios you have and so forth, and your dilution across the rounds, is going to be a 400% discrepancy between the outcomes that you ultimately have. It gets worse, because the ultimate outcome that you had, 1.6 billion in the no discount scenario versus 450 million in the fully discounted scenario, actually should raise your alarm. This is actually the conversation that I had with my client, which was, okay, so you can discount and it's going to have long-term impact on your business. Okay, fine. But this is actually a risk. This is a business risk that they were not aware of, that in my experience, some companies are sort of acutely attuned to, and other SaaS companies just don't get. And especially they don't get it in the sales department. They might get it in the CFO might get it, the CEO might get it, but there is this sort of missing conversation within a lot of high growth Series B, C, D, later stage SaaS companies, where we're focusing too much on the commercial aspect of growing top line ARR and not enough on the financial aspects of what kind of business are we actually building and what kind of enterprise value are we building for ourselves and for our investors. So let's back it up. If the fully discounted scenario creates a business worth $450 million at a 15x PE multiple on $30 million bottom line, what does that mean when you're trying to raise your Series B, right? So, because we said in the previous scenario that, well, we are raising the Series B on a 15x ARR multiple on 25 million ARR, right? So that was $375 million. So close to 400. Now, if the Series B investor can see, okay, I'm going to bring $30 million to the table, we're going to need another 120 in Series C, and then this business will be worth 450 million, and I'm getting in at a pre-money of just under 400, then they're going to say no. Then you're going to say, well, you're building a good business, but we are not the investor. And now you're forced to close out the business and sell it at 25 million ARR, because you're not going to be able to raise the Series B. If you're able to raise the Series B, it will be because you offer them a better valuation and a much better term sheet, right? So you have a startup, you had 17 million ARR, you now have 25, you're growing, it's going great, it's a great market, your customers love you, you're getting no with your funding partners. It's one of the most shocking things that I see founders face is that they think they're doing everything right. They are growing the ARR, they are, killing it in the market, they have a great product, but they fail to raise the later stage rounds because they don't understand the financial Excel math that starts to push back against them. So it's one of the things where I usually say that in the beginning you raise on a PowerPoint deck, and at the end you raise an Excel sheet when you're raising capital. And so let's follow the logic here and see what might happen if we manage to raise anyways, despite this sort of not so good end outcome. So let's say that you actually managed to raise a Series B on this fully discounted scenario at 25 million top. Maybe you only raise it at a multiple of 8, right? So you raise it at or maybe even you manage to raise it at a multiple of 10. So you raise it at sort of 250 million. So you say, okay, from a Series B investor, I still have a 2x upside, and they are making money. So maybe that is, it feels like a safe bet. Let's just say that. And 2x on 30 million capital deployed is still good. And maybe they'll fix it. So, but what is going to happen is that the term sheet that you're going to get in the Series B is going to be not favorable. So it will have a lot of liquidation preference. You will likely go back to sort of reverse vesting your founder shares and so forth. So if anything happens between when you take those money and you sell that is not favorable to you as a founder, you will lose out. And you have a very real chance with these types of term sheets that you have to sign at the Series B and C level on a not super favorable to you scenario that you will lose everything, right? So because you're asking people to come in with, let's call it serious money, put it at risk in your hands, and if something goes wrong, you still want to get paid? No, they want to get paid first. You're the entrepreneur, you take the risk, right? And this happens again in the Series C, where you raise maybe on, so if the Series B was 250 million and they know that the end scenario is going to be 450, there's not a lot of room, right? So maybe you manage to magically convince them that the outcome is going to be even better, and you raise it to 350, right? Let's say you're a really good equity salesperson. So, but still you're going to raise at 350 pre-money, but you're going to raise 120 million, right? So your dilution in these rounds, because the valuation is lower, is going to be much higher. So you start with 40% equity, and before we said, well, maybe you're diluted 30%. You should be lucky with this sort of backflow impact into your financing round to be diluted only 50%, right? And likely you're going to be diluted much more. But let's say that it's going to be 50%. So your 40% is now not cut down to 28, it's cut all the way down to 20, right? So that means that the exit scenario of 450 million is not going to be 125 million, now it's going to be 90 million, if you're lucky, twice over, right? So you need to be lucky to actually raise the rounds. You need to be lucky to not have a hiccup go wrong so that the term sheets essentially take away your money from you. So, but even at this, you can see that from 90 million, which is the new low given the impact on the funding rounds, all the way up to the, let's say, high no discount scenario where we exited a 1.6 billion unicorn at 500 million for you. Now we have sort of a 6x differential, so a 600% increase in the outcome for you as a founder in the discount versus no discount scenario, right? So, and this is if everything goes right in the full discount scenario, right? So if you decide to discount fully and then execute perfectly, execute all your funding rounds perfectly, there are no hiccups in the market, you will end up in a perfectly executed scenario with 90 million. If you had a magic wand and you can name it and you executed the no discount scenario, you would end up with 500 plus million, right? So the compounding effect of discounts and margins and unit economics and total addressable market and capital rounds in your business is huge to you as a founder and to your investors. Yeah, so this is just the layout of what is at stake, what are the dynamics actually on discounts on you as a business. And you might sit back with the very real objection like, yeah, but we need to discount, right? The customers are not going to buy it if we don't discount. And so the first question you ask is, well, really though? Like, Of course, there is a price elasticity where more logos, like more number of customers, will buy if the price is lower. Say, assume that's true for your market. But of course, you need to sort of not only focus at the number of customers, but also at the actual top line and the actual bottom line. So here's my sort of 4-step approach to working with this in your business. So the first step is you need to realize that this effect matters, right? So if you don't realize it, you can't control it, you don't do anything about it. So just realize it. Step 2 is do back of napkin math in Excel, right? Something like I've just laid out and told you, like just run your numbers in Excel. Like, okay, I'm going to raise this much money and we're going to have this ARR and we're going to have these multiples and so forth. Try to be honest with yourself and sort of see what the impact is long-term between now and exit. And just plug in your existing discounts and your existing list prices and just see, hey, if I was able to run one scenario or the other, where would I end up? And then likely the operational scenario that you can execute is somewhere in between those two. But just run the simulation so that you get sort of the end points, right? The 90 million versus the 500 million. And then third step, you take control of the discounts. You pull them away from sales and say, hey, this is not just a commercial issue, because you realize that salespeople will think that if they're closing any ARR, they're doing a good job. They have a sort of a commercial approach to it, where they say, well, I have this customer. If I don't sell them, they're going to be gone. So we'd better make some money compared to less, right? Yes, if you're early stage, but at these stages of the business, not so much. You actually want to close them different. So sales should not have the mandate to determine the price levels. You in the CFO and the CEO office, maybe with the chief of sales in there as well, should determine the price levels, looking at these sort of backup napkin scenarios that you have. Because price levels are not only a commercial decision, they're also a financial decision. So you need to, at this level of, let's say, executives in your organization, have a look at these price level and margin levels and discount levels and decide amongst yourselves which of the scenarios you want to pursue, right? And once you're there, then the fourth step becomes to test it. And that essentially means try to essentially give no discounts. That would be my first test, right? If you can actually close a meaningful amount of your pipeline, your customers with no discounts, then that's potentially what you should do, right? If you can see that you have the price elasticity does that if you give a little bit of discounts, you close way more, then just let the math do the talking, right? So if you close 10% less customers at a 5% discount, maybe that is worth it, or maybe that's not worth it, right? You know what I mean. So, but if you give 30% discount and your conversion rate only increases 20%, that's probably not worth it, especially if you have these actual cost of goods sold, that your margins are not 100%. If your margins are more like in the range of 30 to 70, then it starts to really matter, because the issue compounds, especially at the exit stages of your company. So the 4 steps are: realize it, 1, 2, map it out in Excel, just like figure out what the scenarios are. 3, take control of the discounts as a CEO or CFO and say, this is the room that we decide discounts in, not in the sales call. And then 4, test what works and let the math do the talking. So this is a kind of conversation that, in my experience, has been helpful to a lot of the clients that I work with that are trying to sort of plan out their futures in the next 2, 3, 4, 5 years across multiple financing rounds when launching new pricing, or just trying to optimize what they currently have. So I hope it's useful to you, that I gave you something to think about. Maybe you want to take a look at your discounts and just do the scenarios on your own. So just check out what is at stake. I hope that it helps you. And take care. All right. Cheers, guys.